Hello and welcome to Crescent Connections. Today is our monthly webinar where we bring you experts to learn and so we can ask questions in different topics. Today we're going to meet with Gerry Spitzer from Questar Capital Partners, and we're going to discuss exit planning strategies and specifically employee stock ownership plans. But let me turn it over to Gerry for a minute so he can introduce himself.
With Coopers and Lybrand in New York, and basically started there, worked my way into a sales role to see whether I like sales in combination with accounting, really disliked accounting, and then kind of made my way to the Merrill Lynch training program in the early 90s. And from that, met my partner, and from there, we're still partners over 30 years later. And it's really worked out great. The wealth management space is really fascinating, especially I know we're talking about business owners today. I think having them as clients is fascinating. I know we're going to get into ESOPs and all, but the mind, understanding the mind of the business owner, what he or she is looking to achieve is kind of a fun space to be in. And you'll see that the background that you have really is relevant to kind of providing the kind of services that we're going to talk about today.
Yeah, excellent. Excellent. Thanks, Gerry. So we are going to talk about ESOPs, but just tell us generally what are the most common business exits you see?
So ESOPs are one of basically four ways that are the most common ways that middle market, let's define the market. The middle market companies that we deal with are companies that are valued typically between 20 million and 200 million. So when you're below a $20 million valuation, many folks in the marketplace will term that as small businesses that are typically sold by business brokers, right? But when you get to that 20 to 200 million mark is the middle market, and those companies have a more complicated exit strategies typically. Number one is going to be ESOPs. Number two is going to be private equity. Number three is selling to a strategic buyer in their space.
Right.
And number four is probably the most common exit is that family members end up inheriting the stock or given the stock to pass to generation. And that's why many ESOPs is one of the four options is common among multi-generation families that started the business with a great grandfather and they pass it along. And then sometimes you get to a point where succession planning we'll talk about today, but there is no family members to move the shares to, or family members don't have an interest. And then what do? You have a little bit of guilt in selling it to private equity and cashing out when four generations before you
right.
started this company. So depending on the passion involved in your succession planning that is really deeply important here, those are the common ways to sell companies.
Right. And can you explain for someone who doesn't understand it what an ESOP is? Structure of an ESOP?
An ESOP is a method to sell a company basically to your employees. So you're basically, instead of selling to private equity, which you're going to have a new owner that owns a majority, they can come in and typically bring in their own management team. And typically private equity are basically, they're buying you for a reason. That is to basically increase profitability, increase value, and resell you again in several years. That's typical.
Why a private equity would purchase you. Just clarifying what you said.
Right. And in a strategic, like I'll talk about a tire and auto company we did an ESOP with in Boston. They had a very good bid from a strategic in the space, but they know that the second they sold that business to them, their name was going to change to that strategic.
Right.
So in ESOP, you're selling the company to an ESOP trust. The shares end up in the hands of the employees over a period of time. But the key features there in why they're important in an ESOP is that you keep your legacy, you can still have plenty of time for your succession planning, and there's some major tax benefits for the selling shareholders. And we'll talk about those in detail.
Right. From what's the typical time the owner keeps control? How long does it take the ESOP for the owner to be completely out generally?
So that's a good question. So it's going to depend on the profitability of the company, but right. A typical transaction might look like this. A $50 million company, let's just say it's one owner to keep it real simple. Many times it'll be brothers, many times it's multiple owners, but in the case of if it's one owner, he sells the company to the ESOP today, there's going to be cash at close for the owner that we'll talk about how that happens with bank financing. But let's just say, for argument's sake, it's going to be typically about 20% of the valuation. So in this case, $10 million cash at close. And if the owner elects Section 1042 of the IRS code, you can sell those shares tax-free. So the $10 million comes in capital gains tax-free. The $40 million seller's notes, which are basically IOUs from the company to the selling shareholder, get paid over a period of years. And the period of years is going to depend upon the cash flow projections that the investment banker does. Right. So that owner, to get fully paid out his or her share of that 40 million, could take anywhere from 5 to 7 years. So that's why it's typically not ideal for an owner to be like in their 70s to do the ESOP, because the stress of staying on those years might be tough in your 70s. Right. So I'd say the ideal ages, and baby boomers are, getting older, as we know, it's just a fact, is probably from mid 50s to mid 60s is that sweet spot of doing an ESOP, so that you have enough runway to stay on, in control of the business, build out your succession plan, get your seller's notes paid, and kind of eventually kind of step away.
So how it works constructively, as the profits pay off, the employees start to get that's how the employees start to get more and more ownership, right? As the profits of the company go over the course of the years.
Yeah, it's more of a function of number of years that you get paid out. So Lisa, if it's this $50 million company we're alluding to, Lisa, you're the CFO of that company, and let's say the total payroll of the company is $4 million a year in payroll, and you earn $400,000 as the CFO. Right. The way it works is there's this total amount of shares that are going to get allocated to the employees every year. You would be eligible, for this rough example, about 10% of all the shares given out would go to you based upon your salary divided by the total payroll. So it's all a function of what your pay is. Right. And, rank and file get shares allocated, and you can build up a number of shares. And I have a story from, Sullivan Tire that did their ESOP in Boston. I asked Mr. Sullivan in the middle of this process, so what made you decide on an ESOP? Because I was brought in the middle of the transaction. Okay. And he basically said he was at a public supermarket in Naples, Florida on vacation, and he chats with everybody. And he's at the deli counter ordering roast beef, and he sees a sign behind the deli counter that says, "We are 100% employee owned." So Mr. Sullivan says, "Hey, what does that mean?" He goes, "What it means is I have $1 million in my ESOP account." He goes, "Well, what do you mean?" He goes, "Well, I get shit." And he's in the deli counter cutting this guy's roast beef as he's talking. And he basically says, "You get shares every year allocated to my ESOP account. And when those shares keep accumulating, as the value of public supermarket grows, you got your valuation growing dramatically and the number of shares growing. And it ends up being a substantial amount because, as you know, ESOPs are like 401ks under ERISA. Right. Department of Labor. So that's eventually, Lisa, your question is, eventually the shares get in the hands of the employees over a period of time. Now, if it goes ESOP, and you have a 65-year-old employee that is going to retire in a year or two, that person may not see the benefit of shares handed to them over a period of time. It's going to be those younger employees that need to stay loyal for a number of years. And I think there's an awful lot of research done on the 7,000 ESOPs that exist today, that if you stay, your retention for your existing employees is off the charts compared to the average company.
Yeah, I looked at some studies last week when I was preparing, and there is a lot of them, not just the retention, but better profitability, happier employees. There's, as we've said, and we'll say there's a win-win for employees and owners, at the end of the day.
The owner can keep control and sell their company tax-free. And I will say, when we have a lot of initial calls and meetings, a lot of people are like, this sounds a little too good to be true. And in addition, Democrats and Republicans, which basically don't agree an awful lot, agree on ESOPs. And it's well documented, maybe for different reasons, but they agree on ESOPs.
Right. So where does the initial, because one of the key differences you mentioned, which is important, if an owner needs all their valuation right away, and They need all their money right away. An ESOP is not for them because it's going to take time for them to get completely paid out. But that initial payment, which you said maybe, like, I think in your example, you said 10%.
20%.
20%.
$10 million of a $50 million company, about 20%.
Oh, okay. And where does that come from? Is that a note? Where's that cash?
No, what happens is there's an internal loan, and that loan is part of this 6-month process to get an ESOP done. And it's about a 6-month process with investment bankers, and we'll talk about independent trustees and things like that. You're going to like an M&T bank or a key bank that's like visible in the ESOP space, these regionals, and they typically will say, okay, Lisa, your company is worth $50 million. We're going to loan you 10. And here's a term loan because we know it'll get paid off over a period of time from profits of X number of years at this interest rate. And you bid this out to several different banks and get the best terms, and we choose the best terms for the client. And
you said too, Gerry, when we talked about it, there's a kind of a minimum EBITDA you need to really make these ESOPs make sense.
Yeah, so the minimum EBITDA is going to be somewhere between $2 and $3 million, and that's that middle market. That's kind of the beginnings of that middle market valuation companies, around 20. And obviously, different industries have different multiples, of course. But the $3 million is a mark that says, okay, if the company is worth considerably less than 20, kind of between 5 and 12, 5 and 15, there's several people that have to be involved with the ESOP transaction. We'll talk about the team. Because there's professionals involved and complexity involved, sometimes the overall cost to get the transaction done doesn't make sense for a company without 2 to 3 million of EBITDA. And that's on the low, that's really on the beginning side. Like there's EBITDA companies that are considerably higher doing ESOPs, but that's the bare minimum to kind of make the transaction happy for the owner and the professionals involved, because the most important thing in getting a transaction done is getting the A team, and the A team typically is not the least expensive of the professionals you would use.
So
it's a little bit of a catch-22.
Right. Now it makes sense. So you've alluded to it. Let's talk about that A team. What is that comprised of? What is that comprised of?
So let's pretend, Lisa, you're selling your company for $50 million and it's a dairy company. So we would bring in, as part of this process, part of what Questar does is we talk to you as the owner, understand what are your goals and objectives for selling the business. Do you have family members? Are you charitably inclined? Have you done your estate planning? We kind of get into all those kind of personal financial planning, wealth management topics, really gauge the understanding of where you want to go with this, right? That's really the starting point of this and how it begins. So once we kind of get through that, we bring in a sell side investment banker. That person or firm basically also interviews you, and then they sign an NDA. You send them your financials. They take your financials, develop what they call a feasibility study, and either you're going to be happy with the numbers you see or you're not, right? So either you want to proceed or not. Now, if you say, you know something, I really like what I'm hearing. I like the way this is going to play out. I like the way it's going to play out for myself and my employees, and it's a win-win for everybody. I want to move forward. So they do a true feasibility study, and then we bring in an attorney on your side to negotiate.
Right.
And then on the other side of the transaction, because there always has to be a negotiation on the price of what your firm is really worth. We say 50 million, but obviously there's another side to this. So there's an independent trustee. And the fascinating thing is we would show you 3 different independent trustees for you as the owner to interview. You choose the independent trustee. The independent trustee gets placed on the other side of the transaction, and you're actually negotiating. Your investment bank is negotiating with the independent trustee over the valuation. So they come to terms on a valuation. The independent trustee is going to bring in their own valuation team and their own attorney. So now you see that you're building a fairly complex transaction with basically 6 professionals. So those professionals all play, and this is not even including the accountants on either side. So depending sometimes the complications are, the accounting firm for you, Lisa, maybe is not ready for this or has never done an ESOP or has never really put these numbers together. So maybe you have to find a different accounting firm just for the transaction. So you can see where this gets complicated quickly and you have team members. So that's why it doesn't make sense to do these things really tiny, even though what happens is the owners sometimes fall in love with the ESOP story so much, but then I find out what their ESOPs look like, the EBITDA looks like, and I'm like, hard to break the bad news, but I'm like, it's going to be really difficult to get this done.
Not big enough to cover those costs and make it make sense. Yeah. Do you want to talk any more about the Section 1042, how it's tax-free?
Yeah. So what happens is that there's different structures. So if an organization is structured as a C Corp, C Corps can sell their shares. And what a 1042 looks like is, and I'm sure a lot of your viewers understand what a 1031 is in real estate. So if you have a large capital gain in a commercial property, and instead of selling that property, liquefying and paying the capital gains tax, you can exchange for another piece of property.
Right.
You could do the same thing under Section 1042, is you're exchanging privately held company stock for qualified replacement property. And our role in these transactions is basically helping the owner execute on that 1042 strategy. And we came from UBS. UBS also did 1042s. Like that's where we kind of were starting in this space. Now you could do it in the independent space, much cheaper, and you could price out and look at loans and things like that and be able to compare rates. And I think that that's an exciting part of this as well in the independent space. But basically that 1042, reinvesting the total proceeds of the sale in qualified replacement property allows you to not pay any capital gains tax.
Right.
And if you have low cost basis and you're selling your company for $50 million in the state of New Jersey, you're talking almost 11% in state capital gains tax in addition to the 23.8. So you're talking, potentially 35% or so in taxes. Yep.
And you save on the state side too, you're saying?
Yeah, the combination, because your state capital gains tax would be large, especially in New Jersey. It's a huge tax saving. So what happens is that if you say a company's an S Corp today and they want to do this as a C Corp, they would just basically switch their status to C Corp, and you have to stay as a C Corp for 5 years before they could switch back to S. So if you're an ESOP and you're an S Corp, you basically exist as a tax-free entity moving forward. You don't pay income tax on any of your earnings going forward. But if you sell your shares as an S Corp, you need to pay capital gains tax on the sale of your shares.
Okay. Yeah, makes sense. I mean, it does kind of sound a little too good to be true. But I have not heard anything in the news about this going away. This was not in the last bill. This is here. Like you said, it's popular on both sides of the aisle, and it's popular for employers and employees, which can sometimes be on opposite opinions on things. So it really is a great transaction.
But Lisa, I think a lot of the reason, you haven't asked me this yet, but the reason why there's only 7,000 ESOPs in the country.
Yeah.
And, my feeling is this, that if I'm the owner of a cement company, and let's just say I'm not necessarily financially astute. I know the cement business. I'm good at it.
Right.
We do great paving and everything else, right, for our clients. And I'm getting that age where I want to start exploring a sale because I don't have any kids going into business, blah, blah, blah. So where do I turn? I turn to my lawyer and my accountant more than likely and say, hey, look, would you introduce me to a middle market investment banker? I'm looking to potentially look at a sale of my company. And I will say about 95% of middle market investment bankers in this country do strategics and private equity only. Yeah. So there's many times I really believe that these owners don't even explore the ESOP option because they don't know it exists.
Right. There's not enough experts in the area. Well, hopefully 1 million viewers are going to view us on this, Gerry, and you're going to have so many more people who want to do ESOPs.
Just 1 million? Wow. That's it.
But no, I mean, it's such an interesting topic, and we did have a lot of people talking about wanting to hear about it. And like you said, you have to be the right type of owner, the right size business, but it can really work. Are there any businesses that types of businesses you do a lot of ESOPs in? Any industries?
Yeah, I mean, it just so happens that there's no natural buyers of construction firms. So construction, architecture, and engineering, I will say these days, they make up probably close to 60% of all ESOPs.
Oh,
And
wow.
then every other industry, really, we've done a trucking company. We're doing right now a farm equipment company. And we're doing a company that helps family services with autistic children. So it's crazy the variety of types of companies that can do an ESOP. And I think that after the owners listen to the pros of the ESOP, either they kind of fall in love with the concept or they just move on. Because like you said, if you need or want more cash at close than 20% of the value, because what happens is, like, we talked to a furniture manufacturer in Florida, and what he did was he kicked the can down the road too long. He was 72 years old, and his balance sheet was the company. He had a house and he had his company. And you know what? He didn't have the time, the 5 to 7 years payout on the ESOP. He needed more of his cash at close.
Right.
So he needed to sell the private equity.
Right. And there does seem to be an awful lot of private equity buyers out there that I more than 10 years ago that are out there. And it's got to be, it almost looks a little bit easier money quicker than going through the whole ESOP and paying for it and the complication. You really have to want to do it to do the ESOP.
Oh, yeah. Our most challenging ESOP, I will say, was a group of neurosurgeons in New York. And what happens is you have 14 owners. We'd all have to decide to move forward, and it took an awful long time because everybody had their own lawyer, their own accountant. Everybody wanted to understand the transaction. So, you know, you may say, "Why I don't have that much hair on my head?" That was part of the reason why. But anyway, it got done, and I think it got done because the CEO finally basically said, the CEO is one of the surgeons, but he was the anointed CEO, and he just said, "Look, we're doing this. If you want to stay, stay. If you want to leave, leave." And one person did leave, but essentially they all did it. And they were very happy with the transaction. And it all got done under Section 1042 and all. So it was great.
Yeah, no, that's great. It is, like you said, if it's for the right person, the right company, it's a win-win for everyone all around. I'm trying to think if there's anything else anything else we didn't talk about you want to touch on, Gerry? I think that's most of my things I had.
No, like I said, I think it's all different industries. I think it really comes down to if legacy is really important to the owner and keeping the legacy, keeping the company name, if keeping control of the company for at least several more years. But the advice I would give is that the succession plan, building out the succession plan, if it's going to be family, that's one thing. If it's not, you got to build out a succession plan. And I will say, you are able to do a partial ESOP. So you don't have to sell 100% of your shares. So we did have instances where the owners are in their 50s and they feel like they just want to take some chips off the table, you know, like you're winning at blackjack in Atlantic City or Vegas, and you have all these chips in front of you and you're like, you know what? I don't want to lose all these chips. So I want to literally cash out of some, hold on the rest, and roll the dice with the rest and keep my equity. So there's plenty of companies that do partial ESOPs where you hold on to shares and then you take some chips off the table. To qualify for Section 1042, you need to sell at least 30% to an ESOP. And the really fascinating part is there's a lot of RIAs, Lisa, in our business that are considering ESOPs as well, because, you know, you think about this, a lot of financial advisors are aging as well. And guess what? A lot of them don't mind staying in the business 5 or 7 years for the payout. So there definitely are opportunities for RIAs and firms in our space to do ESOPs themselves. But you need 20 employees, and you need the EBITDA. And legacy is important, like everything else, but then you get to keep control. So you could see the attraction. But like I said, the execution of it is not always easy. But again, it's finding the A team, and that's what we bring to the table.
Right. It's so interesting.
And the last thing I want to do is, you know, you can contact me at jerry@questarcap.com if anybody has any questions. And we are launching a podcast, which we launched last week, that is going to be, I'd kind of describe it as the softer side of M&A, right? Middle market M&A, the softer side. So we're going to talk with owners that have done ESOPs. We're talking to lawyers in the space. We also have some non-ESOP type people that talk about leadership and succession planning. So all topics kind of related to exit planning, and I think it'll be a fun podcast, so tune into that, and it's on Spotify as well. The name of it is Buyouts, Business, and Bourbon.
I do like the name. And the name of our talk today is Crescent Connections, and we aim to do it the third Tuesday of every month at noon. And so we're trying to interview all different people that our clients could find useful in all different areas. I mean, our clients really run the gamut from business owners to, employees, single, divorced, families. So we're just trying to bring different people on with expertise to help, share information. So thank you, Gerry, for taking the time today. Hopefully people
You're very
learned
welcome.
a lot.
Thanks for having me.
Thanks
for
so
having
much.
me, Lisa.
Okay.